All right, good morning. It is Monday, April the 20th, 2026. We hope everyone had a nice weekend. Another nice weekend down here in Charleston. A little colder this morning, but it'll be a good day to head out in the parking lot there. We do some walks around the parking lot. It'll be a good day for that today, it looks. The Kroll family had a really nice weekend. My son, who is not quite 5, but we kind of had his little birthday party. He's a big fan of airplanes, right? So my wife put together, she did just a great job kind of organizing. We've got a little like patio, kind of outside area out back, and with just a bunch of tape, we made some runways kind of all over the place on the cement, and just dumped a few dozen airplanes that are scattered around our house. And then, he had about a dozen little buddies from his class come over, and it was a big success. Everyone had fun, some food, some cake. No one got hurt. No big disagreements or fights. So all things considered, a successful 5-year-old birthday party. So that was good. So we hope you had a nice weekend as well. All right, looking at markets last week. Really, really good week for markets. All right, I read one of the fastest turnarounds in the last 36 years, right? So just obviously markets pulling back with some of this uncertainty in the Middle East. And then the recovery kind of started the previous week, but a really strong week last week with most benchmarks 4 to 6% higher on the equity side, right? And really what we're looking at is just the probabilities of worst case scenarios in the Middle East being reduced. Right, so markets are all forward-looking probabilities, which I'll touch on in just a minute here. But on some of those headlines, you saw oil retreat a good bit, right? So backing off $100 a barrel by quite a bit. Up a little bit this morning. Again, it's just this bickering back and forth. But oil retreating. You see bond yields stabilize. Earnings also appear to, we'll see. We're going to get into earnings season here again, but by all indication, it looks like it's going to be another really strong quarter of corporate earnings. At the end of the day, that's really what's driving stock prices. And then just from economic data perspective, last week we received the producer price index, so PPI, and that was better than expected, as in lower than expected. All right, so that index, the price of goods increased only 0.5% month over month, which was well under. I think most economists thought that might increase by a full percent. So coming in at half that was also encouraging. All right, so just with some of the recent volatility, I thought just for kind of educational content here this morning, just to bring up the point, like, why you really can't wait for markets to quote unquote feel better before investing. And so the reason I bring this up is, we had a number of clients kind of ask about it, and really good questions, and most of it recently surrounded this most recent IRA contribution deadline, right? So in the grand scheme of things, for many of the families we help, these are kind of smaller amounts of money. But I received the question from a number of clients, and a very fair question, a good question, like, hey, like should we just kind of wait to see how things play out here with Iran and everything? There's a lot of uncertainty. And so should we wait until things feel better, right? To be adding new funds to the market, right? And this is and just in doing what I do for a living now for a while, I've seen this play out so many times now over different headlines and narratives. But at the end of the day, what I've found is usually when you hear you're gonna wait to invest until things feel better. Usually what that ends up meaning is you're going to miss the next 10% rally in the market almost guaranteed. 10 to 15% high, like you're going to miss that almost guaranteed. And really, it's just it's a real like behavioral psychological challenge, but this is just this is where the understanding of the way like markets actually works becomes so important, because remember, markets are forward looking. Okay, so they're not pricing in today's discomfort. They're pricing in the probabilities of what things are going to look like months from now. Okay, like that's what markets are doing, right? So when things are bad and they don't feel good, but then they end up being less bad than what was originally feared. What happens is you can have big rallies, right? So anytime the market's down, and many times for good reason, that there's concern, there's uncertainty, that there's risks, like you see those probabilities of worst case scenarios, other nasty scenarios, like those are getting priced into the marketplace, and that's why you get corrections. But then what happens, like so that's when things feel uneasy. And as soon as market participants, very smart market participants, start looking at probabilities and is this really going to be a risk 9 months from now? And they start weighing these probabilities. And if it's not, markets will take off before you're ready for it. All right. And this is the trap that investors can get themselves in. And again, I see this a lot, right? Because so the trap works like this. It goes, okay, things are really scary. Things are risky. I want to hold a high cash balance at this time. All right, so then you hold a higher cash balance. The market goes higher, right? Because whatever the risk might have been at that time, it's no longer a risk. So by definition, that means the discount is out, right? So it's in the past. So markets rebound higher, 10, 15% many times, and then the investor deploys the cash when things feel better and you see where this is going, but so now you feel safer, but now you've bought new stocks at higher prices, like you're in at higher prices, right? So I don't know, this is one of those topics, maybe I should host a webinar on it, but it's, bottom line, you really can't wait for things to feel better before investing. And one thing that I've said a number of times is just like that uncertainty, that the volatility in the marketplace, like that is the price of admission in order to have longer term, higher returns that are going to exceed inflation in the long run. So that being said, questions, comments, concerns, please don't hesitate to reach out to our team. We always love hearing from you. And we hope you enjoy this beautiful time of year out there. All right, we'll talk to you soon. Thanks.